Yeah, good evening, everybody. Welcome to our monthly webinar for the month of April 2024. Uh, uh, start with the presentation, and to start with, let's start with the portfolio performance. So as you can see, Coffee Can portfolio has done reasonably well so far last 3 months. You can clearly see that the last 1 month return at about 2.8% has beaten the benchmark of Nifty, which was up 1.6%. And the last 3 months have also been fairly good, with about 3.4% return versus a benchmark of 2.9%. The main contributors for the Coffee Can portfolio for the month have been Avenue, which was up about 16%, Bajaj Auto, which was up 15%, and Pidilite, which is up 10%. Bajaj Auto has been a recent addition in the portfolio. And was added about 4 months back and has delivered more than 40% return in the last 4 months. The portfolio draggers were KFIN, which was down about 10%, Container Corp, which was down about 10%, and TCS, which was down about 5.8%. KFIN and Container Corp essentially down because of some correction which was being witnessed in the mid cap and the small cap space as well. If we move on to the good and clean mid-cap portfolio, if you look at the 1 month return, it was down about 1.5% versus 1% positive return for the mid-cap index. Unfortunately, three large weights of ours sort of did not perform in the last 1 month. So if you look at CDSL, it was down about 10.8%, Kajaria down about 10.6%, and Emphasis, which was down about 9%. However, if you look at the top performers, they were KEI, which was up about 8%, Chola up about 6%, and PI, which was up about 5%. Moving on to Emerging Giants. Emerging Giants is a small cap fund with 95% allocation in small cap. Unfortunately, the month of March was bad for small cap, with the index down by about 5%. However, the small cap portfolio was down about 7.5%. So obviously, as compared to index, it had underperformed. The main drivers for the portfolio were Safari, which was down about 16%, Mass Financials, which was down about 16%, and Mastec, which was down about 14%. So some of the heavyweights in terms of our stocks were down more than 15% in the last 1 month. However, the top performers were Venus, which is up 3%, Home First up 3%. Just to highlight, small cap correction had led to some weakness in the performance. But if you look at from April onwards, both Good and Clean and Emerging Giants are making a comeback, with Emerging Giants up about 6.5% since April, and Good and Clean up by about 4% since April. If we move on to 10x, so 10x in terms of March, it was about negative 2.5% versus benchmark, which was up about 1%. The bottom performance obviously was again Safari and Kajaria, which have been names in the Good and Clean and Emerging Giants as well, and Orchid Pharma. The top performers were KEI, which was up 8%, Go Fashion up 8%, and Chola up about 6%. If we move on to our newsletters, so as I highlighted earlier, that we'll be coming up with interesting content every month. This time around, what we did was we spoke to a lot of channel partners across the country. So these channel partners would include speaking with suppliers, distributors, competitors, etc., etc., across the country. So what summary, if I have to share, obviously then I'll go into individual sectors. But as far as the result season for Q4 is concerned, we are not that optimistic from the checks which we have done across sectors. What we understand is that this quarter is likely to be a sort of a washout quarter, especially when we compare it with the first 9 months of the financial year. And the key reason for the drag across sectors seems to be margins. So whilst revenue growth may not disappoint, but we believe there will be some disappointment as far as margins is concerned across sectors. And that is primarily led by higher cost of funds in banking, two price cuts taken across sectors to regain market share. But obviously, we continue to remain fairly optimistic around FY25 because of some of the steps which have been taken by a lot of companies across sectors to start gaining market share. Obviously, we'll get into details as we go into each sectors, but just to summarize that 4Q, one should not have too much expectations as far as the result season is concerned. Coming to sector specific, if you look at financials, whilst the credit growth could moderate to about 12-13% on a YOY basis compared to 14% plus in the last 9 months, we believe that the operating profit growth, which is the PPOP growth, which we refer to, could lag the credit growth. The main reason being is the pressure on NIMs. So we expect in the fourth quarter companies to report NIM pressure across various subsegments, which could include home loan, which could include personal loan, etc., etc. And clearly, this quarter is unlikely to be a strong quarter from a PPOP perspective. Also, we've seen some moderation in terms of various subsegments like personal loan, etc., etc. Given that the regulator has come up with a lot of caution on various banks which were lending on the personal loan side. In fact, that had been the main driver of loan growth for several banks as well as NBFCs. So clearly, we are looking at Q4 being a year, Q4 being a quarter where the loan growth moderate and there could be some pressure on NIMs. If we talk about the retail or the consumer durable sector, and that sector continues to remain under some pain. So when we spoke with a lot of electrical companies, kitchen appliances companies, consumer durable companies, we got a feedback that excepting for fans and AC as a subsegment, all other segments have seen revenue growth being either flattish or marginal negative. And one of the key reasons for that is that the channel is sitting on a very light inventory. And the main reason for that has been the higher interest cost, which is affecting their working capital requirements. On the real estate side also, what we are hearing is that a lot of developers were sitting on lower inventory as far as building material items is concerned. And the main reason for that is obviously elevated interest rates. So if we exclude ACs and fans, the retail and the consumer durable sector continues to sort of remain flattish. Moving on to automobiles, if you look at two-wheeler as a segment in specific, we are hearing very positive outlook from the discretionary sector, which is in specific higher CC segment, where one of our portfolio companies has seen very good launches. And obviously, Ayesha in particular has been doing very well. So two of their new launches have seen a big success. As far as TVS is concerned, their EV portfolio continues to do extremely well. So therefore, TVS also continues to do well. And on the Two-wheeler side, we are seeing very strong comeback, given the significant comeback which we've seen on the rural side. We had also written a newsletter in February where we did highlight that we are seeing some pockets of recovery on the rural side, and two-wheeler obviously has led that recovery. We expect FY25 to be a year where mass consumption will also make a strong comeback. In fact, we've added one name, which is VMart, on in the emerging portfolio to get sort of to enjoy the benefits of mass consumption coming back. As highlighted earlier, the building material sector obviously is likely to witness a sluggish 4Q. But given that there is an expectation that there could be interest rate cuts in the second half of FY25, we expect FY25 to be a year of building material companies. In fact, we are also hearing that several of the real estate projects which were launched in the last 3 years are likely to see possessions fairly soon. So to that extent, we believe that tiles, wood panels, electrical companies will see a strong comeback. And hence, we believe that whilst FY24 was a weak year for building material companies, but FY25 could be a year where these subsectors which are highlighted will make a strong comeback, and hence one should not write off building material sector as far as FY25 is concerned. To macro and market update. If you look at interesting trends, if you look at the last 10 to 13 years, what we have seen is we've seen significant consolidation happening across several sectors, and that's why we continue to remain fairly positive on the market leaders in the respective subsectors. So if you look at overall cement as a sector, the top players enjoyed a market share of about 35% within them. That has increased to about 58%. If you look at aviation, the top players which had about 75% market share, that has increased to about 83%. If you look at telecom, the top players enjoyed a market share of 65%, which has increased to about 90%. And if you look at banking as a sector, therein also we've seen top players increasing market share from 47% to 62%. So clearly, the trend is that the larger player is becoming more and more bigger across subsegments, and we believe that the large market share gains is happening from the unorganized segment. If we move on to balance sheet improvement, what we have seen is that especially in tier 2 and especially within tier 2 and tier 3 companies, there have been signs of balance sheet improvement as well. So if you look at, if you make an index of tier 2 and tier 3 companies, what we have seen is that the gross debt to equity has come off significantly from about 0.7 in FY18 to about 0.4 in FY23. And if you look at return on equity, the return on equity has improved from about 3% to about 11% over FY18 to 23. So what we are trying to say is that at one end, there is increasing consolidation, but the greater benefit of this consolidation is not by the market leader, but by the second or the third largest player in that segment. So clearly, what we are seeing is that the second and the third player in that segment is making a strong comeback, led by reducing leverage and improving ROE. Also, what we are seeing is that some of the pockets like paints, jewelry, apparel, in that segment, unlisted companies are also trying to make a comeback. So essentially, if you look at tier 2 and tier 3 companies on the unlisted side, which are large companies, they have also seen a significant comeback as far as revenue growth is concerned. Moving on, we are of the camp that capex, especially from the private sector side, will see a significant pickup over the next 3 years. So one of the main concerns has been the subdued private sector capex over the last 5 years. There have been theories that government has led the capex in the last 3 years, and going forward also government will lead capex generation. But our belief is that private sector capex will make a strong comeback over the course of next 3 years. And few of the sectors where we are already seeing good announcements include cement, steel, both flat and long, hospitals, aviations, also several other small sectors. We have seen private companies lining up for the capex revival. In fact, if you look at private sector sanctions by banks, they have seen a steady state improvement. Also, the kind of rush which we see the private banks make for deposit generation, that also indicates that essentially they are seeing inquiries. Otherwise, you would not have seen the kind of fixed deposit rates which we are seeing. So clearly, the increase that we've seen in the fixed deposit rates is clearly a pre are sitting on several inquiries for loan sanctions, and it's only a matter of time that you will see a significant pickup. And also, if you look at the capacity utilization in the private sector, it's close to about 78%, and that is the range where the private sector starts looking at capex. Otherwise, they'll start losing out on revenue opportunity. In terms of valuations, obviously God has been extremely kind. So Sensex and Nifty both are at all-time highs. In fact, there is a talk going on in the market that now both gold and Sensex are on par at close to about 72,000. So gold for 10 grams is also 72,000, and Sensex is also at around 72,000. So clearly, markets have been really kind. And result into that, Nifty P now is at nearing historical averages. So it's not that markets have been expensive. In fact, fundamentals have also been very, very strong, and earnings growth in particularly also has been very strong. And to that extent, the Nifty P continues to be near historical averages. It's not that it is at a significant premium as compared to historical earnings.